this is a piece that we published last week, and we were talking about the FX trading boom that is taking place in Latin America and has been taking place for over 2 decades. We were fascinated to, first of all, learn that if you look at how much the Latin American currencies, and this is, by the way, just looking at the 6 most traded currencies in Latin America, which in order are the Mexican peso, the Argentinian peso, a Chilean peso, and the Brazilian real. We can see that the growth from 1998 up to 2025, so up to this year, has been enormous. It was at below $20 billion in trade, and now we're approaching 300 billion, half of which is represented by the Mexican peso. And just that number by itself of $300 billion to me was mind-blowing. I mean, $300 billion is about the size of the GDP of Peru, for example. So just alone, that number to me was very, very interesting to see. To first of all find out that is happening, and this is happening to what is called over-the-counter trades. So that opens up a lot of questions, like, why is there so much trade? What does the actual trade represent? What is going on behind the scenes? And the answer to that is, I'm sure we'll learn a lot more from Craig about this, but an interesting thing is that only about 40% of all that volume that trades hands around the world, specifically Latin American currencies, comes from what are called spot transactions. So this is basically just buying, exchanging currency, the transaction that most of us are probably familiar with, of buying and selling your pesos, trading them for another currency directly. That only represents 40% of all that volume that I just showed you. And the other 60% is represented by different types of derivatives, as they're shown here. Most of these I actually don't know how they work myself, so I'm looking forward to learn from Craig about the different instruments that exist to trade currency. And the most important thing, I think, is where are they taking place? They are taking place at what's called CME Group, which is based out in Chicago, and that is the largest derivative trading exchange in the world. And this has huge implications for Latin America, mainly because Latin America is a region that is its economies are very much based on trade. So whatever happens to currencies can impact so much of what's going on in all of the countries in Latin America. To give you one example, a very personal example might be that you bought some dollars 2 years ago, and now you find out that wasn't a great trade, depending on where you are. But then you can also go to Argentina. We actually published a piece earlier this year about how the most efficient and profitable banks in Latin America were all 3 of the most efficient ones were all based in Argentina, and we wonder why is that. And once we dove into the financials of the banks, we found out that the reason was actually very simple. They had a hedging strategy where they bought a huge amount of US dollars, and that ended up giving them better returns than any bank in Latin America just by holding on to dollars for the year of 2024. So that's just to illustrate how impactful different FX strategies can be for every Latin American. And I'm sure all of us are familiar with, in some way, with exchanging currency, because it's very much something that we as Latin Americans have to think about. So with that introduction, I believe, Craig, are you here?
I am. Can you hear me?
Yes, I can hear you. So I just want to introduce Craig. He has been involved in one way or another with trading and with financial markets. He's based out of Chicago, of course, and he's now the head of education at CME Group. And he has been since at least 2000 in some way involved with CME Group. So I think it's fair to say that he has seen a lot of stuff from 2000 up until now, and so it'll be really interesting to learn from his experience and for him to tell us a lot more about how this and many other types of derivative trading work. And finally, I just want to mention who made this whole webinar possible, which is AvaTrade. AvaTrade is a platform for exchanging this type of contracts, and they're present in most of Latin America. So thank you, AvaTrade. If you're interested in learning more about them, please reach out to us, and we can definitely get you to the right people. So with that, Craig, do you have the ability to?
I think someone else was going to try to share the deck.
Okay.
Because I don't, and I really apologize. I haven't been able to download the GoToMeeting app, so I had to join from a browser, and I know this took a while, so I do apologize for that.
That's okay. I had the same issue. Thankfully, our attendees have been very patient with us. So
I emailed the deck in a PDF document if someone's able to share that.
Yeah, if you want to email it to me, Craig, and I can share it, or
email. It should be at the top of your email. I hope.
Okay.
Yep. There we go.
We already have it up? Oh, yeah, okay.
I see the title slide.
All right, great. Take it away.
Great. So again, and I apologize, but thank you very much to Latinometrics, to AvaTrade, and most of all to everybody that took some time out of their night to join us here. We really appreciate it. Like Ernesto said, I've been in the futures business for the better part of 30 years. It's really the only thing that I've done since I got out of college in the mid-90s. And a lot of my time has been spent here at CME Group. So I think what we thought we would do is one, kind of talk a little bit about what CME Group is, because actually, even in Chicago, sometimes I'll be at a trading show or something like that, and people ask me what we do, and we're a company that's been in Chicago for since 1848, so for a long time. And sometimes people don't even know what we do here in Chicago. So we'll start there, and then we'll go into a couple different products and talk about how they work. And then, I think most importantly, if anyone has questions, please feel free to ask us during the presentation. We're more than willing to answer questions as we go along. It's not going to interrupt us or anything like that. So please feel free to ask any questions that you might have during the presentation. So maybe we'll go to the next slide. Get started here. This is a disclaimer. I'm going to leave it up just for a second. I'm not going to read it word for word. What I would say while this is up is we have an educational portal called CME Group Institute. And if you Google CME Group Institute, it'll take you right there. It has a lot of information on futures and options on futures. And whether you've been doing it for a long time or you're just getting started, there's something there for you. And I don't think there's any such thing as knowing too much. So please check that out. And with that, we can move on. Great. So what is CME's role in this whole global futures landscape and really the whole financial market? And if we go to the next slide, like I just mentioned, we've been around since 1848, and we're going to go into a little bit of the history, but CME Group is made up of what used to be 4 different futures exchanges: the Chicago Board of Trade, the Chicago Mercantile Exchange, the New York Mercantile Exchange, and the Commodities Exchange. Throughout the years, CME has acquired those to form the publicly traded CME Group, and we're going to get into that. But at the end of the day, since 1848, we've been around to manage risk. That's the fundamental reason that futures exist. But within that, there's a whole ecosystem of different customers that make it work. And if we go to the next slide, we'll look at some of those. So within our markets, we have banks. And banks might be hedging risks that they have, like they may be hedging interest rate risks or stock equity price risk or things like that. Or there might be a desk at a bank that's speculating in our markets. We have hedge funds in our markets. A lot of that is going to be speculative trading, but there might be hedge funds that are hedging in futures, something that they've done in the cash market. So they can play both roles as well. Intermediaries are more like brokers. So they facilitate buy and sells for their customers. And then, of course, we have farmers, ranchers, processors, and producers. So those are generally going to be hedgers, right? So if you're a farmer and you're planting a certain crop like corn or soybeans, and you have a risk that the price is going to go down by the time you harvest that, you might use CME Group to hedge that risk. Or you might be a farmer that thinks that maybe you know a little bit more about what the price is going to do in some of that. So you might actually hedge some of your crop, but also speculate in the futures market because you have an expertise, you have a knowledge of what happens in these markets. We have what are called corporates or commercials. That might be something like United Airlines that has a risk of the price of crude oil going up and therefore the price of jet fuel going up. So you might use CME Group crude oil to hedge that risk. So a lot of the what we call corporates or commercials are going to be natural hedge players or hedgers in our markets. We have asset managers, people that, what we might call real money managers, people that are managing people's money with stocks. They might want to use futures to hedge that. We have proprietary trading firms. Those are market makers, and those tend to be speculators. Then, of course, we have individual traders. And I would say that mostly individual traders in our markets, and there's more and more of them trading futures, are trading in a speculative way. Individual traders are less likely to be hedgers in our markets, but they're trading all of these different markets, whether it's stock indexes or whether it's like the currencies that Ernesto was talking about. They're using that to speculate on price. So if we go to the next slide. These are all of the different products that CME offers. And one of the things that we talk about at CME is that we offer the widest variety of products among any major futures exchange. So you can trade things like stock indexes. So the S&P 500, which is the most widely benchmarked stock index in the world. So there's more money benchmarked to the S&P index than any stock index in the world. And what that's comprised of is really 500 of the biggest stocks in the US stock market. You can trade futures on the NASDAQ 100, and that's been very, very popular with individual traders lately. A lot of that's because of, you may have heard of what they call the Mag 7, which are the big 7 technology companies that are in the NASDAQ 100. So a lot of people have gotten interested in trading that index because of NVIDIA and Tesla and Google and things like that are all in that index. The Dow Jones Industrial, that's 30 of the kind of in more traditional type companies. And then the Russell 2000 is a stock index that's made of 2,000 of what we call small cap stocks. So smaller companies that make up, and they kind of give you an idea of what's happening in the market with smaller companies. We have cryptocurrency futures, so Bitcoin, Ether, Solana, XRP. So if you want exposure to cryptocurrencies, you can get that. Then, of course, we have metals like gold, silver, copper, energy. I mentioned WTI, crude oil, natural gas, the agricultural products where we started, 200 plus years ago, corn, soybeans, wheat, and then like cattle. And then, of course, interest rates, which I think is very popular in certain places. You can get exposure to the United States Treasury market, which I think by a lot of measures is the biggest debt market in the world. And then, of course, the foreign currencies that Ernesto was talking about. We have some of them listed there, some of them what we might call the majors, but we also do have some of the what we would call emerging currencies like the Mexican peso, the Brazilian real, and currencies like that are listed here at CME. So why I think that is important is because some of these are not correlated to one another. So there might be trading opportunity in the stock market, in the stock indexes right now, but maybe WTI crude oil is stuck in a range and there's not a lot of opportunity. But because we have this wide variety of products, there's a likelihood that something is offering trading opportunities. So if we go to the next slide, and then the next one, sorry. So this is a real quick history. So, and I was born and raised in Chicago. I've been in this city for most of my life. So I actually personally really like our history because it's a Chicago company. So we were founded, like I've said a couple times, in 1848. That was the Chicago Board of Trade. And I'm not going to go through all of these, but like I said, at that time, it was a grain exchange. It was a place where literally farmers would come to trade. If they had wheat and corn and things like that, they would trade at the Chicago Board of Trade way back in 1848. And what I think is interesting is that you have to go all the way to here to 1972 to find the first year where a financial future was introduced at the exchange. So all the way until 1972, which really wasn't that long ago, we were really more of an agricultural type of an exchange. And then in 1972, we introduced foreign currency futures. So those currencies that Ernesto was talking about were actually the first financial futures that were introduced at the exchange. And then from there, we introduced things like the treasury, the interest rates, and then we introduced the stock indexes. But then if you go over here to 2002, that's when the Chicago, what was then known as the Chicago Mercantile Exchange, became public. That's when we IPO'd and became a public company. In 2007, the CME bought the Board of Trade. So I mentioned there were two large futures exchanges in Chicago. In 2007, the CME bought the Chicago Board of Trade. So that became then one futures company. And then in 2009, I mentioned we bought the two New York-based exchanges called the New York Mercantile Exchange, which that's what got us into the oil or the energy futures, and then the COMEX, which is what got us into the metals futures. So all of these exchanges have now combined to become the CME Group. So when you hear someone say CME Group, that's how it came to be. So if we go to the next one. And I like this slide. I don't always put volume numbers in my presentations, but this one's so dramatic that I think it's worth looking at. If you go back to 2000, we were doing, CME Group was doing about 2 million, volume of about 2 million contracts per day on average. In only 25 years, that's increased to 31 million. So from 2 million to 31 million contracts. It's what we call ADV, or average daily volume. It's a dramatic increase, and it really shows you how futures have grown over the last 2 decades, and particularly here at CME Group. Now, a lot of that did happen, I think, because it was around 2000 that we really started to see the markets move from the floor, or open outcry, where people were literally in pits yelling and screaming their trades, to the electronic trading that we really know today. So, that opened up access and really helped CME Group become a truly global financial marketplace. Ernesto, I'll stop for a second. Maybe you can tell me if I'm going too fast, or if you have any questions on anything that I've said so far.
If I can figure out how to unmute myself. Yeah, I was wondering about this chart here. The term of volume, I think, can sometimes mean a lot of different things, but in this case, the term volume just means these were 31 million. For example, today, CME emitted 31 million contracts. Like, can you, maybe to someone that, like myself, that's not as knowledgeable,
Sure.
like, what does that contract mean? What's like at the receiving end of one contract? What's at the sending end of one
Sure.
contract?
It's a
And
great,
maybe breaking it down, like
yeah.
what's the biggest interest these days in terms of like I'm assuming the trade in 2000 or 2 million, like very different sort of industries that your customers were looking to trade to today.
Sure, that's a great question, and it actually is a little bit confusing because it's different than, for example, if you're familiar with the way the stock market works. If you're buying stocks, for example, you're buying shares of a company. So if I buy 100 shares of NVIDIA, I'm actually buying those shares from somebody who's selling them to me. Whereas in futures, it's simply just a contract. It's a contract to buy or sell something at some point in the future, and it's done on the CME Group exchange. So when we say volume, what we mean about that is if I were to buy, I'm just going to use, I'll use the euro currency as an example because you were talking about currencies. So if I was to buy one futures contract of the euro currency, so that's the euro currency versus the US dollar, and let's say, Ernesto, you were to sell that one contract to me, we've created volume of 1. So so if you then consider that there's thousands of participants in our markets every day, and they're trading what we would call we call it a one lot in our world, or one contract. Like the example I just gave is we did 1 for volume of 1, but if I bought 100 from you, that would be volume of 100. So I bought 100, you sold 100. We don't count that as 200, even though we both did 100. We count that as volume of 100. So when we look at 31 million contracts, that's total out of all of those products that I was showing before, and some more that I didn't show on that slide. All of the products that were traded at the exchange today, on average in 2025, when I did the slide, was about 31 million. Now, you ask about the product mix. It probably hasn't changed that much since 2000. It's just more of everything. So from an institutional perspective, interest rates are the CME's biggest product. So the treasuries, and then what we have some short-term interest rate products. Those are the highest volume. But among individual traders, I would say the stock indexes are by far the most popular product by individual traders. So, and within that, I would say it's the NASDAQ and the S&P futures. And we're going to get into how the NASDAQ future works just as an example in a second. But those are the most popular products that individuals trade. Now, you do bring up a good point, because if we go even way farther back, individual traders actually were trading more of interest rates and stuff. But I would say over the last couple decades, it's been stock indexes. There's a lot of individual interest in energies like WTI crude oil, in metals like gold and silver, in foreign currencies like you were mentioning. I would say those are some of the bigger ones that individuals are interested in.
Awesome. Yeah, no, and to your question of if you're moving too fast, I don't think so. I think that it's good. My only other question, but I'm sure you'll get into it, is you mentioned I think one thing that I've been thinking about a lot, especially now that the stock market seems there's a lot of like mixed feelings in terms of how risky it might be to get in on it right now. I would love to hear just a little bit about how investors usually think about using these type of contracts for managing their own risk.
Sure.
That's called hedging, I believe. So maybe you'll get into it later in the presentation, but that was just another thing.
Yeah, why don't we go, we'll skip a couple slides and I'll get into that when I talk about the NASDAQ as an example as to how futures work maybe. So if we go to the next slide, I know I talked about this, so let's go to the next slide. So why do individuals trade, and really why does anyone trade at CME? One of the most important things, and I think one of the biggest reasons that individuals and institutions incidentally trade at CME, is because of what we call capital efficiencies. And the other way to say that, and I want to be very clear about that, is that futures are leveraged instruments. So what I mean by that, and I'm going to get into what we call the micro NASDAQ future in a minute. So we have a futures product called the micro NASDAQ. And that's different than the mini NASDAQ, which is a bigger contract. So the micro NASDAQ essentially gives someone exposure to about $50,000 worth of NASDAQ. But to hold that, someone only has to put up about 4,000 US dollars. So you only have to put up a fraction of the amount of exposure that you're getting to a certain product. And that's true of gold, of WTI, or the stock indexes, or the currencies. It's, you know, somewhere, generally speaking, somewhere between 3% and 7 or 8% of the underlying exposure that you're getting. It's a little bit higher in the cryptocurrencies, but for most of our products, it's that. So that can be a powerful tool if people use it responsibly, because that leverage also works against you if the market's working against you. So I'm always very clear about that. Is that we call it a very efficient way to deploy your money, but you also have to be very disciplined, you know, manage your size, manage your position, manage your P&L because of that. So that's one main reason. We're also open 24, so we open Chicago time at 5 p.m. on Sunday evening, and we're really open until about 4 p.m. on Friday afternoon with a 1 hour break between 4 and 5 every day. But other than that, we're open from 5 o'clock p.m. Sunday evening through 4 o'clock p.m. Friday afternoon. So if if something happens overnight and you have a position on, our markets are open. You know, and that can be a geopolitical thing, that can be an economic thing in Asia, or an economic, you know, while we're sleeping here in our time zone, something might happen in the Asia time zone, or something might happen in the European time zone. Our markets are always open. I'm not going to get into the tax stuff because that's different in different jurisdictions. One of the things we talk about is that if you want to get short a market, if you think the price is going to go down, all you do in a futures market is you sell it. So in the stock market, there's different requirements, and there's costs like called borrow costs, and there's things called locate requirements. None of that exists in the futures market. If you think that the price is going down, it's as simply as you sell it. If you think it's going up, you can buy it. And it's really that easy. There's no other considerations there. And then the other ones I think we'll get into, so I think we can skip ahead, but those are some of the main reasons that individuals trade futures. So I talked about, I've actually covered a lot of this. This is just an introduction to our equity index markets, which again are the most popular markets among individual or retail traders. And the two big ones are the S&P 500 and the NASDAQ 100. That's where we see most of the volume from individuals. And I think if we go to the next slide, we get into the example that I was talking about. So here's exactly what I was talking about. So I mentioned that we have, I mentioned two of the three products that are on this slide, and I'll talk about the third product. It's a newer product, and it's more of a developing market, but I'm going to talk about all three of these. So I mentioned that there's the E-mini, which is kind of misnamed because we introduced the E-mini back in 1997 when the price of the NASDAQ was much lower than it is now. So as the price has gone up, that product has become a bigger product. Actually, the E-mini NASDAQ might have been actually after 1997, but it's been around for a long time. But the reason I say it's misnamed is because it's not really a mini. So what it is it's a contract. At the time I did this slide, the price of the NASDAQ was about 25,000. So the way you get what we call the notional value, or how much exposure you're getting to that index, is we multiply it by what's called a multiplier in futures. So each of these products has its own multiplier. In the case of the E-mini NASDAQ, that multiplier is 20. So if you multiply 20 by 25,000, you come up with that $500,000 worth of exposure, which is a lot of money for an individual. for an individual trader to get essentially $500,000 of exposure to the NASDAQ, that's a lot. So what we did then in 2019 was we introduced what's called the micro E-mini NASDAQ. So instead of a $20 multiplier, it's a $2 multiplier, which means that instead of 500,000, it's exposure of 50,000, which is a much more manageable amount of exposure to the NASDAQ for a lot of individuals. And you can see what I was talking about before. In order to get $50,000 worth of exposure to the NASDAQ, you have to put up about $3,000 for that. So a small fraction of the exposure that you're getting. And then more recently, we launched what are called spot quoted futures. These are a little different because they're quoted slightly differently than a futures product was. But really the main thing I want to emphasize about the spot quoted NASDAQ is that instead of a 2 multiplier, it's 1/10, which is a much smaller product. You can see instead of $50,000 worth of exposure, you're getting about $2,500 worth of exposure. And to hold that, it's only $150. And again, this is all at the time I did this a few weeks ago. And it's changed a little bit, but not by much. So those are like the 3 different sizes of products that we have, depending on how much risk you want to take and how much capital you have. And you can see that spot quoted is much, much smaller than the other 2, which makes it a nice product for someone that's either getting into futures for the first time and doesn't want to take on the risk of a micro, or that just doesn't have the capital for it. So, and so now I'll get into, now that I've introduced the NASDAQ, Ernesto, I'll get into your question. And it's a great question. So what if someone is holding those 7 stocks that I mentioned, NVIDIA and Tesla and Google? I can't remember, Facebook, I think, the 7 stocks that make up what they call the Mag 7 now. And maybe they've made money because they've been holding them for a while and the price has gone up, but they're afraid that, we're coming into an earnings season, for example, and they're afraid that the price of the stocks that they're holding is going to go down. Well, they can sell them and get flat, or they can hedge some of that risk, or try to hedge some of that risk, using NASDAQ futures. So presumably, and again, there's an art behind this, it's not a science, but presumably those stocks are going to be highly correlated with the NASDAQ 100 futures. So if you're long $50,000 worth of those stocks, you can try to hedge that by selling maybe 1 micro NASDAQ, thinking that if the price of those stocks goes down and you're short the future, you can make up some of what you might lose in the stocks in that futures position. Now, there's a lot of math that has to go into that, and someone that is doing that has to figure out how many futures contracts they want to use, what the correlation is, and things like that. But that is a potential way that some people do, and institutions do that all the time, like money managers and things like that will use futures to hedge a stock portfolio at certain times.
And I assume the what's attractive about this is, obviously, let's say that my portfolio is worth $500,000 I have in the S&P 500, and I can just hedge that entire bet with a much smaller percentage of my
Capital.
total net worth of my capital by selling this contract as a leveraged product.
That's exactly right. Now, and I want to be very clear about this. If for example you are holding 10 big technology stocks that are all in the NASDAQ, you would use people would generally use a historical correlation, and they'd figure out how many futures, but there's no guarantee, right? Because, maybe one of those stocks actually goes way up and the other, 8 of them go down. So, it's not an exact science, but absolutely using futures to hedge a stock portfolio is something that a lot of people do.
And on the other side of this, worst case scenario, I guess, is the market continues ripping, and let's say I did that trade. I basically lose that investment of the 30,000, but it was I guess from a risk perspective, it was kind of like an insurance policy. It was just like the cost of doing business.
That's right. The way I would look at it is yeah, I would look at it as you are giving up potential upside of your core holdings, and that's what kind of like the cost of that hedge, right? Like that hedge, that sort of insurance policy is going to cost you something if the stocks were to keep going up. So that was just an example of how the different sizes work. And just a couple things. I explained the notional. The other thing is, if you look at a futures contract, they don't tick in dollars and cents. So that particular NASDAQ contract, you might see a price on your screen that says something like 25,027.00 bid at 25,027.25. So that 0.25 is the smallest allowable distance between the bid and offer. And in the micro NASDAQ, because again, that multiplier is 2, that 0.25 difference represents 50 cents in real dollar terms. So it's just a little bit different because they have this thing called that multiplier. You have to sort of do that little math in your head on how much each 0.5 or how much every full point is worth. So in the case of the micro NASDAQ, that full point would be worth $2. So if you bought one micro NASDAQ and the price went up by 1 point, that would be a $2 impact to your P&L. If it went up 100 points, that would be a $200 impact to your P&L. And that's a little bit different than the stock market, where that impact to your P&L is dependent on the number of shares that you bought. In futures, it's dependent on that multiplier. And it's just one of those things that you have to get used to with futures. The other thing I'd point out, when I said margin, I talked about how much you had to put up to hold a position. That's not a loan like it is in the stock market. It's more of what I would call a performance bond. So it's an amount of money that you have to put up that says, I'm good for this position, but it's not a loan from your broker, and you're not getting charged interest on that. I'm going to go over this quickly because I hear it a lot. I hear people say, I don't want to trade futures because I'm afraid that an oil tanker is going to show up in my front yard or something like that. Because some of our products are what we call physically delivered. So if you hold a futures contract until it expires, one of two things is going to happen. In a physically delivered contract, and I want to be clear, like crude oil is a physically delivered contract. So if your broker, and your broker wouldn't allow you to do this anyway, but if they did, or if something went wrong and you were holding a crude oil futures contract when it expired, you would have an obligation to make or take delivery on that. Now, the reality is a firm like AvaTrade is not going to allow you, an individual, to hold a crude oil position until it expired. They're going to make you get out of that position first. But if you did, that's how that expires. Now, in a cash settled product, which is what the equity indexes that we've been talking about are, when that contract expires, we simply move the money one more time. So if you made money, it's going to be a credit. If the position went against you, it's going to be a debit. We cash settle it, and then the position goes away. So there's no delivery obligation with a cash settled product. So what I would say is that if you're looking at futures markets, one of the things you want to know is this physically delivered? And then I have to get out of it before expiration, which you can do by selling it if you're long or buying it if you're short. Or is it cash settled, which means that I could, if I want to, I could hold this product until it expires.
What does that mean in practice? Like, for example, for someone that actually trades these and is actually in the industry of oil tankers, does that mean that there's always someone at the end of these that waits till expiration? Yeah,
that's a great question. And some of those institutions, those commercial companies, they do want to take delivery, or they do want to make delivery. If you're an oil producing firm or something like that, you may want to accept delivery, you want to make delivery. So that's exactly right. So when it expires, if you're short if you're short that contract, let's use WTI crude oil, you would have to make delivery, and it's actually, and that's one thing about futures, that they're very defined contracts, so they're very specific. You would have to make delivery at a place in what we call a city called Cushing, Oklahoma, as it were, up here in the United States is where that oil would be delivered, and that's where someone would accept delivery of that oil. So that's absolutely right, and it's one of the economics that makes futures work like that, because you know that when it expires, it has to expire at that cash price, because that you could be obligated to make or take delivery. Same thing with like wheat and corn and soybeans. If you're holding, a long position in corn, and it goes into expiry, you've essentially bought 5,000 bushels of corn, and you have to be able to accept delivery of that corn. And certainly like a food producer might do that or something like that. So it's a great question, and that does happen. It just doesn't happen with individuals, because most individuals aren't equipped to take delivery of 1,000 barrels of crude oil in Cushing, Oklahoma. They're just not, they don't have the capability or the money to do that, generally speaking.
That's fascinating. And is it safe to say that the mechanism you just described, that's how most of the, like right now we were talking about NASDAQ, you made the example of crude oil. Is that how it works for basically all the products that you outlined earlier? Like does that, for example, apply the exact same way for currency?
Yeah, so currencies are a deliverable product. So that's a great example. So if I'm long the euro against the dollar, and I hold that till expiration, then I would be obligated to take delivery of euro currencies. My bank would have to be able to facilitate, my broker and my bank would have to be able to facilitate that delivery of the actual euro currency. And so there's different. So it's different, right? So crude oil is going to be, because of the nature of the product, it's this very specific place in Oklahoma. Like if you were to take delivery of gold, it's like, gold deposit, gold certificates and things like that. So it depends on the product, but all of them have a different way to make or take delivery, unless it's cash settled, in which case you can hold that until the very last day and it just goes away.
Okay.
So on that slide, this is a very, very simple example. I just want to show how it worked. So suppose a trader, this is totally hypothetical. Maybe a trader thought the NASDAQ was going to go up because of some technical setup they saw in their charts, and they wanted $5,000 worth of exposure to the NASDAQ. Well, they remember that spot quoted future was worth about 2,500, a little bit less at the time I did this. So they could buy 2 contracts of that spot quoted NASDAQ, which would get them close to about $5,000 worth of exposure. And let's say they did that, they bought it at 24,872, and they sold the first one, it went up to 25,000. They sold one of the 2, and then it went up a little bit more to 25,050. Well, the way that works is simply what I was talking about. So you've got your notional value, and again, the multiplier of the spot quoted is 0.1 or 1/10. So if you bought, and your margin on that would be $300, because I talked about one was 150. So the way you would come up with your P&L, and again, this is minus any fees or commissions, you would take that the first contract that you sold, 25,000, minus the price you bought it for, 24,872, times the one contract, times the multiplier, and then your second contract you sold the same thing, 25,050 minus the purchase price times that last contract, gives you a P&L of positive $30.60, again, minus fees and commission. But it's that, it's really that simple. Now you have to know that multiplier to get that, but that's how we would calculate a very simple hypothetical P&L on something like that. So we had talked about just kind of going over some of the other products that we have here at CME Group to wrap this up, and we can then answer any questions. But I talked about the interest rate market, and that's a really, really important market that we trade here. because it's comprised of both the U.S. Treasury futures market and then the short-term interest rate market. I'm going to focus on the Treasury because I think that's what people are very familiar with. But the reason that that's so important is because so many things are driven by the interest rates, right? Like a move in interest rates is going to affect stocks. It's going to affect currencies. It's going to affect gold, right? If interest rates skyrocket, then typically, and not always, but typically the price of gold would tend to fall because gold doesn't pay interest. So something like that. If interest rates skyrocket, a lot of times you'll see stock prices fall, and because the cost of capital becomes more. So that U.S. Treasury market is a very deep and liquid futures market here, but it represents the U.S. Treasury market, which, like I said at the beginning, is by a lot of measures the biggest debt market in the world. So it's a very important market that we trade here, and individuals trade it as well because these interest rates affect individuals as well. So we've talked a lot about energies. I've talked a lot about crude. Natural gas is another product that individuals like to trade. And that's an interesting product because it has a very much a seasonality aspect to it, where they call the summertime, they call it the injection period. So that's when the natural gas supplies get replenished. And then the winter up here in the United States hits, and that's when the natural gas supplies get depleted because people have to heat their homes and things like that. So it's a very interesting product because there's a very seasonality, a very seasonal aspect to it. So those are kind of the two big ones. Crude oil and nat gas are the two big ones that individuals trade here. We can keep going. We've talked about foreign currencies. A lot of we have both currencies, the G10, the major currencies, and then the emerging market currencies. Dollar, or we have a lot of like what we call cross currencies, so you can trade one currency against another, not necessarily the dollar. Then of course the metals market, gold and silver, as you can imagine, have been really popular this year because the price of we've traded up to record prices in both of those precious metals. And then some people will trade gold against silver. So they might buy gold and sell silver, or they might buy silver and sell gold, depending on what they think the relationship of those prices is going to be. But that's been a very, very popular product this year because of the sort of parabolic move that we've seen in prices in both of those metals. And then, of course, the agricultural products that we've talked about a little bit: corn, soybean, wheat, oil, things like that. And then things with feet, like pigs and cows, we trade here too. So we really have a wide variety of different products here that people trade. Oh, do I have that twice? And then, of course, cryptocurrencies. And this slide doesn't even have our most recent cryptocurrencies, which are Solana and XRP. So at the time this slide was made, we had Bitcoin and Ether futures, and now we have Solana and XRP futures. So if you want cryptocurrency exposure, but you don't want a wallet, you don't want the crypto wallet, and you don't want to deal with that, you can get price exposure through futures. And of course, we have micro-size versions of pretty much all of the products that I've talked about, including these cryptocurrencies like Bitcoin, Ether, XRP, and Solana. So, we've tried to make them manageable sizes for people because they are volatile, obviously. So, there's a lot of price volatility in cryptocurrencies. Oh, and then the last thing I'll say, and this is important, we have what we call a clearing mechanism here. And I'll go back to the example I gave before. Let's say I buy one NASDAQ from Ernesto, and you can go to the next slide while I'm talking. I buy one NASDAQ future from Ernesto, and he sells it to me. And let's say the price goes way up, like the price skyrockets, and Ernesto says, I can't pay for my short position. I don't have the money to cover it. Something happened. Well, I don't care, because as soon as I make that trade with Ernesto, CME Group is going to guarantee that trade. So we say that we are the buyer to every seller and the seller to every buyer. So even though Ernesto doesn't have the money, or maybe I bought it and the price dropped by 20%, I don't have the money, Ernesto doesn't care, because the CME Group steps in for every trade and guarantees that trade. So it's what we call counterparty risk. So I don't have counterparty risk to Ernesto, even though we traded with each other, because the exchange steps in and guarantees that trade. And that's important. That's an important part of CME Group. And this slide just talks a little bit about that, but that's essentially what we're saying there. So I think that was the slides I had. Ernesto, if you have any questions, please, and then if anybody else does, let's.
Yeah, if any questions have come up, would love to bring them up. I don't know if I can see them on the dashboard, but Jeffrey, is there anything that we should highlight? I have a few that I can, or at least one that I can ask.
Okay, so we have a question from Ricardo. How does one go about buying a future contract in the CME Group from outside the US? Do you open an account with the CME Group, or would you also, if this person is asking if he pays fees and commission too?
Mm-hmm. That's a great question. And the short answer is no, you don't open an account. And I should have covered that right at the beginning. We are the exchange. And the reason that we like partnering with brokers like AvaTrade is because they are essentially our distribution network to get our products out to people. So you would not open an account with CME Group. What you would do is open an account with a broker like Ava, who offers CME Group futures. And then through your account at Ava, you could trade the products that we have at CME Group. So it's a great question, and there are commissions on trades, and each product has a different commission, and I wouldn't speak to what Ava's fees are or anything like that, but that's how you would do it, and it's a really good question.
Great. Well, we're over time. I think I could learn so much from you, Craig. Thank you so much for doing this. I think my takeaway and my last question is, like, the whole time you were going through the examples, I was thinking how this is probably something that's just starting for the retail investor in terms of, I think for the last 10 or so years, at least, talking about Mexico as an example, we're just now starting to be a country that has a large amount of retail investors, and probably very traditional form of investing, like S&P 500, maybe a few of the Magnificent Seven stocks that you mentioned, things like that. But I think what's very interesting about these type of instruments is to think about them. I think, me personally speaking, as a personal perspective, I don't think they're a good fit for like trying to invest 100% of your portfolio on this. But to me, it's very interesting all the different ways in which you can think how the economy is moving, whether that is currencies, whether that is oils, whatever, agriculture, and how that can help with the way that you're investing the rest of your portfolio, right? Like how it can, maybe you can set up a little bit of a more sophisticated strategy than maybe we have been accustomed to. Yeah,
I think that's a great point, and it is a sophisticated product, and I would encourage everyone to start with the smaller products as you start to explore futures and options on futures, which we didn't even get into. Start small and everything like that. But I think you're absolutely right in that the flexibility that futures give you in all of these different products allows you to get very creative with your strategies and things like that. So you might have a core position in the S&P or in some of these single name stocks. And futures, I think, allow the way I would say, I think what you were talking about is futures allow you, if you want to kind of trade around that position. Like maybe you just want to hold that and that's kind of your core holding, but you have some short-term views on some of these markets. The futures give you the flexibility to kind of trade around that core position that you have. I think is a great way for someone who's, you know, just getting started in some of this stuff to look at it. I think that's right.
Okay, awesome. Well, I think we can end it here. Thank you again, Craig, and AvaTrade for sponsoring this. Jeffrey, I don't know if you want us to share any materials for if anyone is interested, like Ricardo, on how one would go about opening an account.
Yeah, well, actually, I'm going to send our link to AvaFutures, so anybody wants to know more about the future that we offer, and you can go and check it without any, well, yeah, you can check it. And also, if you have any question or something that you can ask, or do you want to ask, you can go to our help area in our website, and we are going to be happy to receive all your questions and obviously to work with you guys.
Awesome.
Great. Thank you to Ava. Thank you, Ernesto. And again, I apologize for the confusion at the beginning.
No worries. Maybe next time we'll do a lot better in being on time and
for sure.
Getting more out of your time. All right. Thank you, guys.
Thanks again.
Okay, bye-bye.